Hello everyone, today is March 11th and this is our session number 10 of the Wyckoff Trading course. And today we're gonna continue with the exercise on volume and price. This is what I call a systematic exercise. What do I mean by that? It systematizes a lot of the knowledge that we already have, and it combines actually not just the volume and price analysis, but also the price structural analysis as well. So that's why I call this a systematic exercise. Our next session next week, March 18th, and we're gonna finish this exercise in the next session. And then session number 12, 13, 14, and 15 are going to be devoted to two things. We're going to talk about relative and comparative strength analysis. We'll talk about some of the filtering. We'll talk about a Wyckoff trading plan. We'll talk about some of the tactics, and I'll introduce some of the concepts that are going to be bridge concepts into the Wyckoff practicum. That, by the way, is going to start, Wyckoff practicum is going to start on the 22nd of April. Our last session of this class, so WTC, is going to end on April 15th. This is session number 15. And then from here, for those of you who's going to take the practicum, we're going to stay on Mondays for the practicum. I'm just changing a little bit the schedule. So the practicum is going to start on April 22nd. A couple of things with the practicum. First of all, let's talk about the price, and let's talk about why the price is such. So the price for you guys is going to be $598. So usually it's $998, but because we're going to have 9 sessions there only. And I would encourage you to take advantage of this opportunity because usually it's 15 sessions. So for those of you who feel like, well, it's just a lot of time, this is definitely better. 9 sessions, and we're going to do 2.5 hours each. So kind of like the same as we're doing this class. But what happened with practicum is there's so much knowledge in the trading course, in the Wyckoff trading course, that I can't give you even with 15 sessions. Knowledge requires practice, and we're just trying to practice with this exercise as much as possible, and I'm still delivering you more and more knowledge. So practicum was designed as a drill exercise, but I'm realizing that having the lecture portion of the practicum and then the drill exercises as the second part of the class works much better for students. So this is exactly what I've been doing this current cycle, for WTC students who have taken the class in the fall. So quite a lot of new things here. First of all, the price. This is great, 9 sessions instead of 15, and then we're still staying on Mondays. So your schedule for classes is not going to change. If you have Mondays devoted, to this course, then you're just going to proceed with the Mondays, and we're going to finish that course. The practicum, the last session is going to be on June 17th. And by the way, you can register now, and I don't know why I didn't put this as an announcement, so maybe next time I'm gonna start putting this. So you can register now, go to our website, find the Wyckoff Practicum course, and sign up, because one of the things that I've noticed with students throughout all of these cycles, and I gotta calculate how many cycles I have actually done with this course, but definitely 20 plus, maybe even more. When students go away, they're kind of excited. Now I'm gonna put this into the action, and I'm just gonna start trading using this. And by all means, please do, because it's gonna show you both. It's gonna show you the improvement that you've made over the course, and then it will show you what else you need to know. So I think that it's extremely important, to have some kind of exposure to the market. My only advice was that is expose yourself gradually, right? So this knowledge apply gradually. Seek confirmation that you know and that you could implement this. All right, so that's that. And what else? For those of you who are not signed up for Linda's Reschke much special, you can still do this. Again, go to our website and sign up. You still can receive all of the recordings and the slides. We just had a session on Thursday that went really well. And we had really good feedback. Now, Linda is not necessarily teaching us Wyckoff method, but she's teaching us trading. And the main thing with Linda and the whole special is just to listen to her, to kind of be in the presence of this greatness and try to extract as many beliefs about trading and markets and how to behave in markets correctly. So extract those ideas as much as possible. All right, couple of questions. Will 9 sessions cover the same content that is usually part of the Wyckoff practicum? Yeah, it is practicum and it will cover the same material, and not necessarily the same because I'm always changing, always adding, always thinking about, what is the best exercise at this point and so on and so forth. So the practicum is a very interesting being, it just kind of develops in the relationship to the group itself. So we'll just have to see this, but it's definitely going to be more of a feel of the Wyckoff trading course rather than the practicum as it was, let's say, a year or two ago. But we still will be doing exercise in each class. So each class, I'm going to have a chart for you where I'm asking you specific questions. Define the bias, define the selection, define the character, and so on and so forth. That's the purpose of that class. Will September cycle of practicum course have 15 sessions, and will it be conducted on Tuesday? From Rama. Yeah, most likely that's how it's going to be. 15 sessions, and then this is probably going to be the last cycle of practicum that we have, because starting with January of 2020, we're going to have Wyckoff Trading Course Part 1, the one that you're taking right now, and Wyckoff Trading Course Part 2, which was a practicum before, but it's going to be more cohesive and it's going to be more comprehensive. For all of the 30 sessions, 2 parts, Part 1, Part 2. So I think this is where we're going with that. Another quick announcement. For those of you who are going to repeat this course during summer, so for those of you who is going to sign up for WTC summer cycle, and I would highly recommend it if you feel that you like the course, but you need a little bit more time to get comfortable with ideas. And you need maybe a second re-round just to repeat this knowledge and cement it in your head. And this is such a great idea, and we have alumni of this course in this cycle as well. So for the summer cycle, the alumni rate is, and this is going to be only 12 sessions. And usually during summer, that's what we do. I don't teach the full course. It's kind of like an abbreviated version just because some people are much busier, and this is just our opportunity to give them that chance to participate. So 12 sessions at 2.5 hours, and the price for the alumni rate, so the regular rate is $798, and then the alumni rate is going to be $498. So really good discount, right? Obviously, not as many sessions, but on the top of this, and we have currently a promotion that is running until March 20th. If you register for the course and you email us after your registration to wyckoffeassociates@gmail.com, and you say that in the title WTC promo, then we're going to rebate you $100 back. So effectively, your price could be $398 for a repeat of this course. So think about this. I kind of wanted to create a very appealing value. It seems like it's such a low price, but I wanted that value to be available to you. For those of you who have taken the class in this cycle and you feel like you want to repeat it, go for it. This is one of the ways to do this. If you feel more comfortable, go for the practicum, because this is the next step. And then if you have any questions, obviously just email me, ask me, and I'll be happy to answer. Okay. Dun, dun, dun. Let me just do this, otherwise I will forget. Okay, hold on a second. All right. Okay, now I can erase this. All right, so today, as I mentioned, we're going to continue with the group exercise. Then we're going to continue with some of the volume case studies. This is actually going to come before the exercise. The homework is going to be the same, and I kind of see a little bit of the deterioration of the participation in the homework. So I'm still receiving homeworks, but not as many as in the first months, not as many as in the first couple of sessions on this exercise. So I want to encourage you to go back, rewatch those videos where we discuss the exercise, make notes, email those to me. This is definitely going to be very beneficial for your development, for knowledge development. Session number 11, next session, basically the same. We're going to finish the exercise. This is going to be the main purpose of that class. If there is anything left on volume case studies, I'll bring it up. If not, then we're just going to move on. But we will definitely finish the exercise next time. All right, let's go to some questions. And the first question comes from Doug. Doug is asking, if effort is the difference in force between the volume signature of two different bars, then is the result the difference in force between the price levels of two different bars? Actually, yes. If you think about, the effort, let's deal with the effort first. So we judge the effort by volume. And we could say that on, let's say, one bar to the upside, the volume was this. And then on another bar in the same direction, the volume increased. So this volume increase in comparison to bar number one, it suggests that there is some kind of difference in the amount of effort that was put into that second bar. So there is more effort to push the price up. So there is a difference in how effort is being depicted right now. The same for the result, because we could see that the result, let's say in this case, is going to be all about, let's say, something quantifiable, something visual for us, right? Because we're reading the chart. So we're going to say that the up spread has increased. Secondly, we could say that maybe close to close, the distance between closes, right? So maybe the previous bar was somewhere here, and that was the previous close. So we see that maybe the close to close is increasing. Then we might say that, let's say on bar number one, there is some kind of supply tail that we see. So we could say that the close to spread has increased as well in bar number two, and it closes so close to the high of that bar. And that would be the difference in the result. Obviously, result is also going to be associated with the intention, and this is something that, not necessarily Wyckoffin, Wyckoff never talked about the intention of the specific bar, but I took it from the significant bar technique that I've developed for myself, and I'm going to introduce this to you guys briefly in this course, and then in more details during the practicum. During the practicum, we're going to be discussing significant bar as an element, as a tool for stop losses, and how we would be moving the stop losses more mechanically. Again, not necessarily a Wyckoff idea, but something that I've realized in the methodology was, in a way, not was heavily underdeveloped. So I had to think about this, and I introduced just basically the way how I, trade swings, or how I define swings. And that became very popular with a lot of students. Usually students opt out, to do that instead of the Wyckoff method stop losses, which are extremely discretionary. So we'll talk about this, and we'll talk about this, in the practicum. But intention is, slightly different, but still under the result. Let's see what other questions we have here. Is result indicated as an absolute level, whether positive or negative, namely, result could increase, decrease to the downside or upside, or is it the delta, change in the value? So definitely we're talking about specific things, Doc, right? So we know what those things that we want to define. And again, they are extremely quantifiable. If we're going to look at the spread, we're going to compare it to the previous subspread, and we will define the spread as the difference between the high and the low. There is a variation on the spread with the true range. We've covered that before. Close to close, quantifiable. Close to the spread, quantifiable. So we are looking at the differences in among these characteristics. And obviously, yes, there is a change in value. So for instance, if the spread has increased, so there is a change in value. If the close to close has progressed more, there is a change in value. If there is the close, like in this case that I'm showing here, bar number two, the close is much closer to the high of the bar, then it's quantifiable as well, and therefore we could extract the value of change. So yes, it's definitely a quantifiable change in value type of parameter. Having said this, you could say that the absolute level is going to be related to the intention itself, right? Because we are going to be looking at some level of resistance or support. It doesn't really matter. And then we're going to be looking for the bar that's going to try to overcome this point of resistance. So intention behind this bar is going to commit above. And therefore, from that perspective, this is the absolute, you could define this in the intention, whether it was fulfilled or not, in absolute terms, because you could define the level of resistance. So let's say it's $100 here. And if the price does not commit, then on the absolute value above 100, then what does it mean? This means that intention has failed. If the price does commit above and closes above, then above 100, then in absolute terms, yeah, the result has changed as well. So really good question, quite a few distinctions right there. And then we go a little bit into more details with sub questions right here. So and let me just kind of like rephrase this a little bit. Actually, let me read this. Is an increase in result to the downside communicated as an increase in the result or a decrease because of a smaller absolute number? Is the increase in result to the downside? Not sure about this question. Okay, so let's just not go there. Is decreasing. Okay. Is decreasing result to the upside communicated as a decrease or increase because it's still higher prices? So, Doug, I think that what you're talking about is in the context, let's say, of an upswing where maybe a result is decreasing, right? So let's say spread is decreasing, maybe volume signature is decreasing. If I understand the question correctly, so how would that be interpreted? All right, so we still would be looking for what? We would be looking for the previous bars, right? And we would be comparing the last bar with decreasing result with the bars on the same rally. We just have to figure this out. So in a way, we could have a decreasing result on a rally in a bullish environment. So hopefully, I'm addressing this in the correct way. I'm just trying to see if I'm understanding the question correctly. So yeah, you could have in the bullish context a decreasing result. You could have in the context of the downswing a decreasing result to the downside as well. Yeah, so that's possible. Okay, really good questions. Some interesting distinctions that we're discussing here. All right, so thank you, Doug. Let's go to the next question. All right, next question comes from Adam. And Adam is asking, was today an ease of movement bar in the markets? So let's look at that. By the way, before, and I feel like I have to clear my throat. Before I answer this, what do you guys think? Is this an ease of movement day or not? So write your answers really quick. Yeah, it doesn't matter what you used. Um, let's just kind of like see what we've got here. All right, so I'm trying to get the answers and I'm not getting anything. What's going on, guys? Okay, let's get into the working mode. Let's go, let's go, let's go. Let's just be quick. don't think about anything else but the question. The question is the last bar and ease of movement bar. Okay, not sure, does not look like one to me. Yes, no, yes. Okay, so we're kind of divided 50-50, right? Okay, so first of all, we'll have more material on ease of movement. So that's still coming. So we'll talk about this in the next session. But let's quickly define what ease of movement is, right? So ease of movement is going to have the characteristics of um, expanding result and diminishing effort, or on diminishing effort. Obviously, in the bias direction, in the direction of the bias. And then under the result, what's important is that we are going to have the intention satisfying the commitment requirements. So let me go through this again. We're going to see the increased result, and predominantly the intention behind this result is going to be positive. And it's going to happen on the decreasing effort. And usually the decreasing effort is going to indicate that the opposing to the bias force, in this case, because the bias is what? The bias is up here, right? So the opposing effort is gonna have the characteristics of weakness, right? So we could say that supply is poor at this point of time. How do we conclude that supply is poor? Well, we look at the chart, we look at the supply that's coming in, and on Wednesday's calls, I was talking about this area right here, and we've talked about how the last bar looked climactic, how there is a very subtle increase of the supply that suggested that's going to be some kind of reaction that's going to happen. Then we said that with this reaction, we need to understand what is the character of this reaction that's going to develop. And then we developed two scenarios. One is kind of like a deep reaction, and another one is shallow. And we want to understand if the shallow reaction comes, that we would have an opportunity to continue the trend. We also would have an opportunity to consolidate. And then if this is a deeper reaction, then we definitely looking at more of the testing type of testing of the lows, of the December lows type of action. Right, so it seems like so discretionary, this whole thing, the method, the logic. But then when you go through all of this, there are algorithms that are basically leading us to specific conclusions. And this is what I want you guys to get, as the skill, as your analytical skill from this course. So let's look at the buying climax here. So very subtle increase of the supply, suggesting that we're going to have a reaction. Reaction timing is being defined by a change of character bar that suggests that we are in a consolidation. We are in some kind of reactionary mode, and off we go to the downside. But now look at how the price goes down. We were anticipating that the price would have some kind of acceleration to the downside. And instead, we see that the volume decreases, meaning that, and obviously decreases, relative to what? Well, relative with which we start here on the increase of the supply. All of the other volume signatures to the downside are decreasing relative to that bar. So therefore, we are most likely seeing a diminishing effort to the downside. So the downside effort is diminishing. So therefore, we would be thinking that this is more of a bullish sign. If this is more of a bullish sign, then our two scenarios on the shallow reaction are going to be probably working much better at this point of time. But coming back to the ease of movement, so we want the opposing effort to be poor. Would you say that supply is in control in the last, let's say, 2 weeks, 3 weeks, a month? Even if I would take the last 5, 6, 7 days, it seems like it is because we have a reaction. But it also could mean that on this reaction that we see, we could say that supply is poor and demand is diminishing. And that's why that produced a natural technical reaction. And oh boy, did we have a discussion in the practicum about technical reaction and technical rally. So that's a little bit more advanced, and we still have to go through this in the practicum and kind of like put the last dot um, uh, on this conversation, but that was a really good conversation. Why is this a technical reaction? Well, because supply is poor, and only because demand has been exhausted with all of this momentum moves to the upside. Look at how many swings we had to the upside. 1, 2, 3, 4. 4 big swings of momentum buying that we had to the upside. So that suggests that we're going to have some kind of reaction just because demand has been exhausted a little bit. And if demand is exhausted and supply is poor, it's going to produce some kind of reaction, but it's not going to be associated with the distribution necessarily. And therefore, it becomes more of a technical reaction within the confines of the upswing. So we are kind of good on the bias here. All right, well, look at the last bar. Let me just clean this up. So let's look at the last bar. And let's go through the definition again of the use of movement. Do we have supply that is poor? Yes. Diminishing demand on the reaction? Yes, we have that. Or diminishing react on the upside? Yes. So now what we want to see is through the reaction that was a technical reaction, we want to see supply being exhausted, at least temporarily, at least short term. And with that exhaustion, now imagine that supply is exhausted and demand is tired too, right? So both of the forces, buying and selling, are hesitant to go into the market and produce the next wave. The buyers are hesitant because, well, they've been buying for 2 months now, more than 2 months. So whoever wanted to get into the position already in the position. That advanced the price so much that there is no value even for some of the institutions to be in the market, to be active in the market right now. There is more value for institutions right now to think about, I'm already in the position. How do I hedge my positions against a possible volatility that might come next? Something maybe like of this variety. sort, where we have more reactions that would create the trading range. So therefore, the buyers are not active. And then the sellers are kind of the same way. Why? Well, because they've been selling on the way down and they had profits. And then once the price went up, what do you think they did? They started selling again, or they added to the position, or they established new positions as the price. And what was the premise of that? Well, because they are thinking here, sellers sentiment. They are thinking that we are in the bear market. That's number one. So their bias and therefore their behaviors are going to be determined by this bias. And secondly, they think that we are in a short-term overbought condition. Literally here, 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 here. And what they do is they sell, they sell, they sell, they sell. To what end? Obviously to a loss. So they're going to produce loss, 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 loss. And this collection of losses, even though they are still extremely sure that this is a bear market, leads them to the state of exhaustion. So sellers are exhausted at this point. So therefore, when they are exhausted, especially emotionally, what do you think they're going to do? They're going to withdraw from the market, and they also become inactive. And therefore, at this point of time, this is what we see in the volume signature. Right? It's almost like there is not a lot of participation. There is some, but not as much as we have had, let's say, in this area right here. So what does this remind you of? Well, probably this environment right here, something like this, where we're just kind of neutral and we have some kind of reactions within the context of the swing. And those are fine. They're still within the bigger context of a much larger, move to the upside. It still tells us a story that, yeah, we are exhausted in general. Buyers are inactive. They're already in the position. And then, sellers are just exhausted with all of the losses. So they are out of this position. And they don't want to come in and short at this point just because they don't want to be wrong again. So that's the whole sentiment picture that we have currently in the market. And it still favors the bullish scenario, no matter how it's going to unfold. Even if we're going to have a much deeper reaction, let's say to 2600 on S&P, something like this, then, it's still going to be within the framework of this bullish momentum rally that we have had just recently. I'm trying to finish on the ease of movement, but there are so many thoughts that come to my mind as we discuss this. So let's talk about the ease of movement again. Do we have an expanding result to the upside? Well, let's go one by one. Let's say an up spread. Did it increase relative to the spread that we've seen just recently? Any up spread? Yeah, if we would look into this area right here on the last rally, actually, even if we look at some of the prior spreads as well, maybe this one is a true range. That's even larger. So we could see that in the last month or so, this is the best bar. So yes, a check. Close to close. Yes, check. definitely we are at a much better close to the upside than what we had here, and we don't even have a close to the upside here. This is close from one down bar to another down bar, but we are overcoming all of those, and this is a much better close. What about close to spread? Yes, as well. And we could probably judge this by maybe like the previous bar that has a bullish characteristic built in it. The price has gapped down on the open, went down, and then closed up like this. So we definitely see the improvement both on the close to close and close to spread and up spread and so on and so forth. And then we said that the effort to the upside for the ease of movement needs to decrease. And we see that in the volume signature. So on a relatively light volume compared to what we've seen before, we are actually moving nicely. So now a tricky part comes, intention. So with the intention here, we should think about this in kind of like two terms: short-term intention and then long-term intention. So short-term intention was to close favorably over what we have had as a commitment in the most recent price action. What was that commitment? It was commitment to the downside, right? So we had closes down, close down, close down. Are we committing above those closes? Could the professionals, even with minimum effort, push the price in such way that it's going to close above previous closes? And we could definitely see that 1, 2, 3. 3 bars, or 3 closes rather, this bar has overcome the latest 3 bars to the downside. And it did so in 1 day. Not in 2, not in 3, not in 4, in 1 day. So it took the price 3 days to go down, and it took just a day and a half to rally off this low. So definitely we are satisfying a short-term intention. Now what about the long-term intention? Well, the long-term intention here is obviously to overcome a resistance that has been created by the high of this upswing. Have we done so? No. And that's the key here to this question. Is this an ease of movement bar? On a short-term basis, yes. On a longer-term basis, we still have to see the commitment above this area. So this bar has all of the characteristics for the ease of movement, and it is an ease of movement on the short-term level, on the short-term time frame. And yet, having all of these characteristics on a long-term basis, it does not show us that ease of movement yet. But it can if the next bar, or within a series of bars, we're going to have something like this. And I've discussed in the WMD what could be the catalyst for this type of move, what would be this type of commitment. And I've shown you guys some analogs from the past. So let's talk about the catalyst. Catalyst most likely is going to be associated with China, US talks. Imagine everything comes together, everybody's excited, and what do you think is market's gonna do? Most likely it's just gonna go to this level very quickly. So there's gonna be some kind of acceleration. That's number one. So that's like the most bullish scenario that we could see. So, and this would conclude this run. After this, we definitely coming back in a big way, because the institutions are going to see this as an opportunity of liquidity value close to the long-term uncertainty high, and they're going to start selling. Okay, so we're talking about the catalyst, yes. What else did I want to mention here? Was this? Oh, yes. So the analogs for this. So look at the Dow Industrial in 1974, 75. And 75 was such great analog for this rally. And if something like this develops, or maybe even like something of a small trading range shape and then going up out of that, this is going to look more like 75. Tesla in 2014, 15, 16, look into that, had the same big structure trading range, and then a shakeout in the middle, and then a quick rally to the upthrust, reaction, and then a prolonged consolidation, almost like a year. And out of that consolidation, then the price started to go up. So quite a few still scenarios of how it's going to unfold, but it's very encouraging how the reaction is behaving. And that's why it's not just enough to identify that the reaction is going to happen. What we should be concerned about is the way how it happens, because the way how it happens will define the short-term bias and sometimes long-term bias as well. All right, great. Let me see some comments here. Okay, so Eric is asking, in this reaccumulation, is public selling or is CO taking partial profits? And Eric, you have to be a little bit more specific. So when you talk about reaccumulation, I'm looking at this whole range right here. So what are we talking about? Are we talking about the specific spot from the low to the up? You mean from this low to this, right? Okay. Well, let's talk about this. So obviously here, extreme oversold, and extreme value, and extreme liquidity. So CO is doing what? CO is buying. Then on the way up, as we look at the momentum, look at where momentum picked, right here on the bar. So all of this is going to be institutional trend followers. What do? They are gradually getting into the position. And they're getting into the position gradually just based on their level of confidence in their systems, and as the system just basically tells, okay, expose yourself more, 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 and more. And I see institutional systems are often based on this, on kind of like this confirmation of the system signals. So asset allocation is based on how the system confirms specific environment. And I'm actually thinking here, and for those of you who are institutional guys, I think that it's a model that was based more on the idea of the preservation of capital. And I think that in the institutional world, we kind of, all of us, are so concerned about losing the capital. Because if you lose the capital, you lose your job. That's what it basically is. If I have my personal account, and let's say that I lose the money, it doesn't mean that I'm going to stop investing or trading, which was in that account. But with and I still have that job. With institutions, it's different. They produce a bad performance, and then their job is in jeopardy. So that triggers specific behaviors by money managers. So they want to be tentative and they seek confirmation. And what it does, Adam, by the way, yeah, I agree with you on that. Um, what it does is money managers at this spot are going to be tentative and they will seek confirmation. And look at this, Adam, what this produces. As they seek the confirmation, they underexpose, and then because of that, they underperform. And they underperform especially, and this is just a variation, especially on momentum rally, like we just had. So the reason why I'm talking about this is because this is the current problem, a puzzle that I'm trying to solve, for some of the institutional clients. Because that's the question that is being posed to me. How is it that, we were correct on the bias of the low, we started buying, and we're still underexposed, and we are barely matching the market? Well, you can't really do a lot here with this rally. It's almost like the solutions to this problem, and I wonder, guys, if you might have other solutions as well. Solution to this problem is going to be all contextual, meaning that in this environment where you're extremely oversold and there is so much value and liquidity, you should be exposing yourself. The only other question here, if this is going to develop into the bear market. So, there are so many thoughts that I have on this. Not necessarily want to go into this because we're already at 4 o'clock almost. But this is a very interesting puzzle, and this is something that maybe I'll discuss more in the practicum. So solutions, contextual, right? So you're going to be thinking about your weight in a specific sectors, groups, and so on and so forth. Secondly, market oriented exposure for your portfolio, and that could be in the case we could be thinking about like specific ETFs that could be related either to the market itself or to specific groups that we think are going to outperform. Then the third one is just portfolio risk itself. How do you manage your portfolio risk in this environment? So if you are underweighted and underexposed, you're gonna lose just on underperformance. So for money managers, not just making money is not enough. It's you always being measured against the market, against your peers, and this is where you could lose your job as well, right? So if you are underperforming consistently, then you might have fewer capital coming your way. So a portfolio risk question is a very interesting contextual, point here, for us to think. So maybe like ETFs, and then also I'm thinking, and I kind of suggested that there might be some smaller leveraged positions that you could use here. Smaller leveraged positions. So for instance, if your institutional risk there is at 1%, you could say that I'm going to expose a quarter of that percent to more risk than usual. But in an environment like this, if it works out, it's going to bring me, let's say, additional percent or percent plus. So in a way, you're kind of creating that 3-to-1, 5-to-1 relationship on reward and risk, and you're improving your equity, and that allows you to outperform. this has to be timed more properly, this has to be selected more properly, but if it works, then you're gonna benefit from that. And then the last one is you definitely want to understand how you're gonna do your hedge at the top of the rally, because you're gonna have your portfolio is gonna have some positions that maybe majority of the positions that gonna advance, maybe like 20% that are not gonna advance, 80% that are gonna advance. Out of those 80%, you're gonna have some of the positions that advanced but not as much. You're going to have 20% that advanced a lot. So you definitely want to keep those, and you want to understand how you hedge against, an upcoming reaction for all of your positions. So maybe the ones that did not advance as much, and you see some short-term deterioration in the price and volume signature, those you could hedge more. And the ones that are there showing more bullishness, you could just leave alone and just seek the opportunity to add on the way down. So quite a few ways, to tackle this problem and to think about this puzzle. All right, so many side notes today, but hopefully all good, guys, and hopefully we are covering some of the material that you could use in your own trading as well. And everything, by the way, everything that I've said, if you have a portfolio of, let's say, 100, 200, 300, 500, something like this, up to $1 million, and we have students like that, this is your topic. This is how to manage your portfolio, how to understand the portfolio risks at the specific structural spots. Again, maybe something a little bit more advanced for this class, but something to think about why you're taking the practicum, because those things are going to come up and we'll discuss those. One last thing, what I like about this last bar, and obviously again, short-term intention is satisfied, but long-term is not, right? So we still have to overcome this point of the resistance that played out so many times before. So until we have that bar, we're still thinking that the long-term intention has not been fulfilled. But look at the momentum, how the momentum comes to, and I'm always using rate of change. I'm not using any other momentum indicators. It's redundant. Just use one, stick to one, and it would be enough. So look at how it goes to the center line and then rebounds exactly off it. So this could be just a short-term technical rally, and that's how the price would behave around that. So look at, let's say, something like this, this. So there is some kind of momentum, let's say, going into the latest rally, and then on the reaction, we're seeing that once it touches the center line, it recovers. So somewhere here, you could continue your campaign or add or establish a new position. All right, great. Good questions, good conversations. Let's go to the volume case studies. We're still studying, how supply and demand interact with each other, how volume and price interact with each other. Excuse me. And we've talked about different types of supply absorption. We've talked about horizontal absorption, or absorption through time, sometimes I call this. So this absorption is going to be observed by ours through different phases. And usually the predominant supply signature is going to be of the diminishing supply going into phase C, and then we could have different variations on this. Vertical absorption, we said, that could take different paths. We could see, and we've studied the kind of like a vertical absorption on the way up, which is more aggressive, where we had a reaction in the direction of the main bias. So main bias here is to the upside. Then we have a reaction, and this reaction has elements of increase in supply. So here we've talked about how on the way down, not only supply but demand is going to increase, and that's going to produce absorption on the way down. And then we said that after that, demand is going to increase even more. And when demand is going to increase even more, the price is going to go up with the increased momentum, and it's going to come to the point of the resistance. Okay, so I want you to remember this because we're going to come back to this thought. Price is going to go up with increased momentum to the resistance, and then after that is going to have some kind of test. Well, for how would it look? It would look something like this, where we have such a big move to the upside, and then it comes to the level of the resistance, and then it's just going to rest right here. So that's one of the elements of vertical absorption that we've studied. So today, I want to talk about feather. And feather was mentioned by, I believe, by SMI, not Wyckoff himself, but by SMI. And then, actually, that was in the original course. Yeah, I think that was in the 1931-32 course. There was a reference to a feather there, and that reference was that the price was kind of like hovering around resistance of the support with diminishing both supply and demand signature, and that produced the condition where on the next leg up, let's say, the momentum has increased. And let me just kind of like jump into this, but before we do that, this yellow highlighted area, think about what I've just said. As demand increases and momentum increases, the price goes up on the increased momentum to the resistance and then produces a test. Does this remind you of anything? What about the chart that we've just studied? We definitely don't have a bullish bias before. We have a trading range here, so non-trending environment. Then we have an increased supply signature that produces this reaction. And it's out of this reaction we see that there is absorption on the way down, but then there is absorption on the way up as well. And the rally usually is going to come to the area of the resistance. So we are right there. This is resistance number 1, number 2, number 3. So we are close to that zone. We are on the border of this zone. And that's why I'm thinking, what is going to happen here? Are we just going to have like a trading range right here and then we're going to go up, or are we just going to kind of like sprint up like this? And I think it's all going to be related to China and how the talks are going to unfold. But it reminds me of that vertical absorption. This is what has happened here. There is an absorption on the way up, and it's vertical because there is no trading range here. I mean, there is, but it's not that big. It's not the absorption that we have through the trading range that we've had in April, May. It's more on the way down and then on the way up. And that's how the B bottoms are being created. There is so much value here on the way down, and there is still so much value on the way up. And again, please note where the momentum signature has stopped. Why did they stop buying here? Well, if this was the previous value, then everything here is undervalued. and still undervalue even on the way up until it hits this area right here. This is institutional undervalue. So they are buying on the way down, they are buying on the way up, and then they stop buying. Once institutions stop buying, how are we gonna see that on the price and the volume signature? Well, the volume signature is gonna be gradually declining. The price is gonna also deteriorate, right? So we're gonna see a deteriorating result to the upside, even though it's still a bias to the upside, even though the price still goes up. Coming back to Doug's question, could we have a diminishing result in the up rally? That's exactly what we have right here. And once they stop buying and they are inactive, we're going to see this also in the momentum. So momentum is showing this, volume is showing this, price is showing this. We could interpret this as diminishing interest by institutions at this point of value, but still it goes up just because no one is selling. They got in and they're not selling. Why? Well, because this is not their typical behavior. They are going to be thinking here more about they're already in the position and how to protect their portfolio. Okay. I don't know. We're definitely on fire today with all of the side note topics. Let's come back to a feather. So here is a feather, right? And this feather is in a free fall. What does it mean? Well, you guys remember, right? You know how the feather flies down, how it falls. It's kind of very slow and gradual, and usually it's just gonna kind of like go from one side to another side and have those swinging type of moves, and slowly and softly it will land on the ground. And if we would be thinking in terms of feather in the market, this type of action, we probably would be saying that there is no increased effort or pressure that is being applied to a feather. And that's why it falls down on its own weight. And it falls down smoothly and slowly. And there is no increased result. I mean, we're definitely going to hit the ground with the feather because it still has more weight than the air, right? So the gravity is going to pull down unless there is some kind of distortion with the wind and so on and so forth. But if the conditions are such that there is no wind, the feather is not going to have increased effort to move down or to move to the side or to move up again. It's also not going to have increased result. It's just going to gradually kind of like go down, down, down. There might be some slight increase in the result, if we go into the whole physics of this thing. I'm not quite sure, but to me, just on the conceptual level, this is just a free fall movement without interruption. And we could see in the market some places like this, where, let's say in this place right here, we see how the price had initial momentum, and then after that, the price goes down, goes up, goes down, goes up, goes down, goes up, goes down, goes up. And this movement is reminding me of a feather. We are close to the breakdown. We are moving to the downside. So result is there, but not dramatic. And then think about if we add more force to push the price down, what should happen? So in the feather story here, we're going to say that if we're gonna put a small stone on a feather somewhere like on the top right here, so we're basically increasing the effort to push the feather down or to push the price down. What should happen with that? Well, definitely momentum is going to increase. With the momentum increase, we're going to have the velocity increase, and with all of that, we're going to have the increase in the result. So, how would that look on on the chart? Well, it's going to look as if out of this feather uh, trading range, once the increased effort was introduced, the price is going to just uh, run down much faster. And that effort is going to be shown to us in the volume signature, or rather than at the change in the volume signature. Right? So volume change, effort change. As this happens, then we're going to see price change. Okay, so let's look at this just on the charts, and let's talk about the characteristics and definition. So a feather is a part of the springboard heuristic that identifies a significant lack of counter effort and counter result, resolves itself in the momentum breakout. Let's look at the bullish feather. We have an established bias to the upside. That long-term bias is to the upside. And this is Apple daily chart. Then we have a counter reaction to that. Counter move. This counter move is going to be associated with some of the supply signature that we could see here in the stop in action, in the sell in, and then still, on the way down, kind of like a general capitulation here. So supply is going to increase. And then after that, what's going to be interesting is that we're going to see higher highs, higher lows for the bullish feather. So here they are, higher high, higher low, relative to this. Higher high, higher low, higher highs, higher lows. But look at the nature with which these higher highs and higher lows are being formed. We're seeing a deterioration of the effort that pushes that price up. I mean, obviously, this segment right here has some momentum. Yes, that's true. But then after that, both supply and demand are somewhat, definitely not negligent, but not that active, right? And we are thinking that demand is diminishing and that supply is poor. And that's the whole situation. And even with that, we're still making higher highs and higher lows. So in a way, a feather is an ease of movement. And because we're making higher highs and higher lows, feather becomes a part of the vertical absorption family. And then obviously, once we come to the level of the resistance, this is where the behavior of institutions is going to change. And this is where they're going to say, well, even with that small effort to the upside, diminishing effort to the upside, the price gives me an absolute performance that I need. It goes up. It doesn't go down. So I might buy more. They might be buying more on some kind of catalyst. Maybe they're waiting for this catalyst, and that's what creates this type of movement right here. Anticipation, but it's more with the bullish bias built into the price action. And then when this catalyst happens, they add more effort, and that pushes the price up with a lot of momentum. So we're seeing a lot of momentum here. And then after such momentum, there is usually a continuation to the upside. Okay, then let's look at the bearish feather. Kind of the same concept, right? So, and we could look into maybe like feather as being this whole thing, right? So we're making lower lows, lower highs in this area, or in a small area right here, a major bias to the downside, a counter move. And I would prefer here to have more demand signature, but there it was. There was an increase in the demand signature right here. And then after that, there is a move to the level of the support. Please notice for bearish feather, this is going to be support. For bullish feather is going to be a resistance. And we are kind of hovering around this area. We're still making slightly lower highs and lower lows on a very short-term basis. And once we are, and once the force is going to be introduced, and we're going to say that all of those people who bought in, and they were buyers for the bearish, in the bearish feather situation, they're going to give up at some point. They're going to capitulate. And this capitulation after the feather is going to produce increased volume signature, increased momentum, increased velocity to the downside, and then obviously the price is going to react also a lot to the downside. It's going to have all of this increased result to the downside characteristics. All right, so I'm thinking about what I've missed here, any substantial pieces that I might have missed. So let's just think together. What are the questions? What are the comments? Because this is not an easy concept. It looks easy, but sometimes I feel like even I myself am not identifying it correctly with a lot of consistency. And the reason why is because sometimes the volume signature is going to increase and it's not going to look like feather because there is like a lot of increase in the volume signature. So we usually talk about the feather as something being light as a feather. And it still moves the price down. So that ease of movement type of thing. Okay, so some comments patterns. Okay, Adam, I'll have to look into that. From Nilesh, how should we trade further to initiate a position? Okay, very good question. So let's develop, maybe like different scenarios, right? So our position here in Apple, and this was 2015-16 trading range. So you're going to identify this high as a major sign of strength. Point number one as a backing up action, going into point number 5. So this is just a trading range of the backing up action here. So how would we be thinking about opening the position? Because of the first reaction and the increased supply on the backing up action, we might be thinking about establishing the position at point number 2 on the reversal. So somewhere here. So this could be our point of entry number 1. Then looking at the feather itself, and I think this is the value of that question, how do we trade it? If we understand that feather by itself is a test of supply at the resistance level, then we know that we could buy the test. So we could find some spots to buy here. 1, 2. And then if we're thinking about what should happen next, if there's going to be a late capitulation of short traders in a bullish feather, and they're just going to capitulate, let's say, on the catalyst or on the breakout, all of the supply that they're going to provide is going to become a market order to buy. And therefore, supply is going to absorb even more. Absorbed more. If that's the case, if there is more supply that has been observed, and not only at the lower price levels, but at the higher price level, what do you think is going to be a long-term bias to this? Most likely it's going to continue, right? Continuation. And if the long-term bias is a continuation, then think about a point of entry. Could we think about a point of entry right here in terms of adding to the position? And I think we can, because let's say on this catalyst, on this momentum catalyst, we're also going to have a test. And that test usually comes within the next 2 days. By the way, it was really interesting how we talked about this in this course, right? Big momentum push on a lot of volume with the gap, usually on catalyst earnings. And then the next 2 days, we want to look at the test. And Linda was talking about the same pattern. And she considers this one of the most reliable patterns. If your test is successful, if you don't have the bodies or the tails of the testing days violating the low of the gap day, and they don't go too much into the gap, most likely there's going to be some kind of continuation. And look how nicely, you would have this trade from 125 to the first change of character bar to 147, so that's $20, or is going to translate into what, about 18% move, something like that, around maybe 18-20%. And then you're making this 20% in 1, 2, 3, 3.5 months. So you have to think in 3.5 months, 20% annualized, it's going to be different. So this is a good swing trade. And especially if you've been entering this position before, like at point number 1, 2, 3, and 4. So you could potentially scale in into the position, and look how nicely it just on the edges of oversold, short-term oversold conditions. What do I mean by that? I believe this was the low, yes. So look at this. All of our entries are clearly close to the oversold, except for the momentum breakout right here. But the momentum breakout entry is going to suggest a strength of the continuation. So therefore, we're still relatively in the not such a risky place. All right, so what else? Joe is asking, for the bearish feather, where did the CO get out? Well, CO got out in many spots, Joe, right? So we're talking about a late institutional capitulation here. So, and by the way, CO could be getting out here as well. And at this point, the CO still has a profitable position. That's number one. And secondly, we cannot call it CO anymore, because we would be thinking that CO is going to distribute the stock at the higher level. So maybe somewhere here, where CO is distributing off the top. Right? Maybe here, on the way up, on the way up, on the way down. So this is CO. And then the rest is just institutional trend followers that are going to capitulate here. So this is early institutional capitulation. So these are this is smartest money. This is smart money. Why is it smart? Well, because they get out at the last opportunity before the collapse. And therefore they give themselves an opportunity, to still stay in the position if this is going to be a reaccumulation. And then the late capitulation is just going to be uh, not as smart, right? Not as smart. And I don't necessarily kind of like these definitions, smart or not smart. It just um, a little bit. I feel like some people could look at this as a little bit, demeaning value, for certain types of market participants. But I know that you guys understand what I'm saying here. So the smartness of the money depends on where they get in, where they get out, but at the same time, there are so many different variations on how institutions behave. We don't even know completely what are the motives, intentions of some of the institutions being in the position that is going down, or shorting in the position that is going up. What if they have some kind of spread trade, right? So meaning that they have two highly correlated stocks. One of them they bought and another one they sold. And this could be here an example with Goldman Sachs, where somebody might be buying Goldman Sachs and don't mind the Goldman Sachs going down, but at the same time selling another stock in the same group because it just outperforms on a relative basis. Um, Obviously, in this case, it should be vice versa. This was actually a trade that I've conducted back then, in 2018 in Goldman Sachs. Um, Let me just capture this. So the trade was conducted here. The entry was somewhere here. I don't remember exactly, but I remember that it was before the break. And I was consulting an institution at the time, so the trade was done with that institution. And it was a profitable trade, but it was executed incorrectly. What do I mean by that? I mean, obviously, selection was correct. The point of entry was correct. Check. Point of entry. Check. We used I think it was actually a cash position. So they were borrowing, and this was a good stock to borrow because this stock usually has a lot of liquidity. So a good institutional, easy, what's the term there? Easy collateral stock that could be used in this situation. And the exit from this trade was somewhere, I don't recall exactly. I think in this area here, um, or even earlier here. So we haven't even experienced, a terminal climactic action. And I was kind of a little bit disappointed how execution has been done on the exit. I mean, obviously for a small swing, that's fine. But the bias was still to the downside, and we just experienced a major sign of strength. So we had this first capitulation that meant that there is still most likely is going to be a continuation. Could have stayed in this trading range and then continued to the downside. I believe the stock went down after that. So execution and specifically exit on their side was really poor. So it's very interesting how you could have the knowledge, but you might not have the skill. You might develop the skill of visual recognition on the chart of what you see, but it doesn't mean that you could execute correctly. Even if you know how to execute correctly, you might be bound by the market opportunities that is being given to you. I mean, obviously the market in 2018 in comparison to 2017 are two different animals. So opportunities in the market availability of opportunities also play a big role. And sometimes we don't learn how to recognize this opportunity. But even if you can recognize the opportunity again, it doesn't mean that mentally you might technically execute it correctly, but mentally you might not execute it correctly. And even then, when you can go through all of those steps and you are at the level of the advanced understanding of not just trading but yourself, uh, you still can fail to leverage this opportunity. And with advanced students, this is a common mistake. Sometimes you see an opportunity, you recognize you have the knowledge and skill to act on that, and then it becomes a wasted opportunity because it was not properly leveraged based on the contextual risk that was present at that time. So it's a process, and this course is just a first step in this process. And I'm still working myself on this, believe me, guys. I mean, like, I'm extremely honest with all of you always, because I believe that if you're not honest with yourself as a trader, you're most likely going to fail. So you have to expose yourself. You have to be vulnerable. You have to be uncomfortable constantly in order for you to adjust. Always make that adjustment. And then only that will bring you to the next level. So that was kind of like my disappointed on the actions of that hedge fund at that time. Okay, so okay, now let's just say in Apple chart, the upward movement from February to April also looks like a feather. If no, is it because it's forming after leaving the trading range? February, April. I see it. This one right here. Well, we have to have some kind of reference to the obviously the resistance, and there is a long-term resistance here for Apple that we've seen, off the 2015 high, I believe. Right. Yes. So you could think that, yeah, the price kind of like does this. I would probably go to the weekly chart just to confirm that. I would say that this is just like a uptrend. It's more established. There is no grinding into the resistance area. It's more of a freer move to the upside. So probably just based on that, maybe I would kind of like not exactly say this, but if you see it like that, that's totally fine. What are the consequences of that? Well, we need to see some kind of momentum move. Well, here it is. It comes on the breakout, so that seems to be in compliance. But again, something where the bias is established and you have a big counter move first, and then you have this vertical absorption. Here, what is the long-term bias? Up. Was there a counter move? Not necessarily. So from that perspective, maybe not. Okay, Doug. Yeah, we'll talk about this maybe later on. I'll have to have more examples of this. All right, great. Let's go to the next one. Okay, well, 20 to 5. Let's talk about urgent demand. That's another volume case study that we have. So usually demand, and we've talked about the ice cream story, right? So demand usually is not going to be extremely pronounced after the absorption of the supply. Why? Well, because think about what happens with the absorption, let's say on the selling climax. So demand increases a lot here. Supply increases as well. So that stops the price from moving down. On the automatic rally, demand is still increasing, supply is decreasing. On the secondary test, supply is increasing relative to what we've seen in the latest rally right here, but decreases, so increases short-term, decreases long-term. And then at the same time, demand is increasing short-term. So there are some buyers that are coming in and getting some value at the low. But at the same time, demand is lower than it was on selling climax in automatic rally. Then we go into phase B. Same happens again. Demand is diminishing, supply is diminishing. Locally, supply is increasing, demand is increasing, that pushes the price up again, and then demand is decreasing even more, and that pushes the price into a sprint. At this sprint, supply is increasing, demand is increasing even more, that's absorption on the way down. And then after that, in phase D, demand could either be low and the price still will go up, and that is a function of how supply has been gradually diminishing throughout all of these areas right here. Sometimes supply has been absorbed. Supply is absorbed at this point so much that even diminishing demand could push the price up. But in some cases, that picture is going to be different. In some cases, we're going to have a lot of inactivity throughout the whole structure. So Apple here shows that for about 9 months or so, we see in institutional inactivity. And there is a reason for that. There is a long-term reason for that. And that long-term reason, you will have to look at the chart since 2001 and 2000 and just to kind of see what that reason is on the long-term chart. But on the short-term chart here, we're seeing how institutions are buying here, institutions are buying here. It's all of this is on the way down. There is no buying whatsoever, at least of the consistent institutional buying, until we probably come to this area right here. And we're seeing that there is a stop in demand that comes in at this point, and as the price tries to commit into the sprint action, there is one close below that support level. We see how the volume signature has increased drastically. And that is a stopping point, so therefore demand has commenced in a significant way, and it's a stop in demand. And it's absorption on the way down. So that we've studied. We've studied the absorption throughout phases. We've studied the absorption on the way down. Now, we also studied a feather. And a feather was a counter move and then a grinding out action, price action, on with higher highs, higher lows. And this would be seen more on the intraday. And then both supply and demand are diminishing. And it comes to the area of the resistance. And at this point, we could be expecting, if the effort is going to come, is going to produce such a huge momentum. Why? Well, because supply has been absorbed so much. And therefore, when demand comes in like this, on the way up, when supply is in strong hands, there is nothing stopping the price from moving in such a quick way. And another thought here on the urgent institutional demand. Think about the word in here, urgent. What does it mean? Why are they so urgently trying to get into this position? And please note, they're getting on the way in, on the way up. They are not at this point, they're not getting on the way down. It's been done before, right? Here and then at the sprint situation. Here they're just like, I don't care, I just want to be in this position. I need to be in this position because I see so much value in this position going forward. It's going to be a leadership stock. So that urgent institutional demand, usually in phase D, is going to identify to us a timing of uptrend emergence. And we know that behind it are going to be institutions and not weak hands. And usually this type of stocks, if you go and you visually backtest a lot of this type of breakouts in phase D, and if you find a lot of institutional volume signature in phase D that pushes the price like this with a lot of momentum, bringing it above the levels of the resistance, then you could make a deduction here that it's not only going to be a leadership stock, but that the trend is going to be sustainable for quite some time, because institutions don't buy for a couple of weeks, couple of months. No, they hold on to their positions based on the requirements that they have, and one of them is, to have long-term tax advantages, have low turnover ratio within their portfolio, and obviously with an intent to outperform the market, so they have to pick the leaders. They cannot pick just the stocks that are going to underperform. So based on all of this, when you see this type of volume signature in phase D, you should be thinking about all of those things. And therefore, this type of the position might be more of a long-term position rather than a swing position. All right, let's see if we have any comments, questions. Eric, I'm sorry, I don't quite understand the question. Okay. If nothing stops the demand due to their accumulation, why backing up action appears instead of going up? Oh, I see. Okay, so maybe I'm grasping this. Okay, so maybe the question is, if there is so much momentum here, right, because of institutional buying, then why, it doesn't go up, but goes into the backing up action? Well, I think it's a structural question here, right? Because think about how supply is being observed. So supply is being observed on the way down, on the way down, on the way down. So the supply needs to be observed at the specific levels. And because there are so many market participants, their emotional memory of where they established the position, where they incurred the win or the loss, are going to be remembered. And obviously, at the points of the resistance, this is where that memory is going to act out again. Or we could state it in a different way. We could say that because of how humans develop systems for the markets, we could anticipate that in the area of the short-term overbought condition, there's going to be some selling. Selling is going to come from mean reversion trade professionals. The selling is going to come from short-term trend followers. They're going to get in right here. They're going to get out somewhere here or on the way down at the first sign of deterioration. And who else would be selling here at this point? Public would not be selling. Public would be excited getting in. CO is already in. institutional trend followers that are long-term institutional trend followers are just gonna hold on and just wait and to see how this position or reaction is gonna unfold. So these are the predominant two groups at this point that might be selling. So they're gonna increase the level of supply at this level of the price. And that increase of the supply and selling is gonna produce what? It's gonna produce a stop in action and a short-term reaction. And therefore, this short-term reaction is going to develop a backing up action. Yeah, Eric? Is that what we wanted to hear, right? So momentum, obviously, if momentum is, if the buying is just continuous, then we would be anticipating a continuation like this. But not in a lot of cases we see that. I mean, this is more something of would be a unique situation. And I would say that in low liquidity stocks, that's a possibility where big institutions are not available and smaller players could manipulate the stock more freer. And I would say that the low liquidity stocks and the way how sometimes they just run up so much, in a lot of cases, this reminds me of the stock campaigns that Wyckoff himself was describing in the course and in his books and in his letters and magazine of Wall Street. And people like Jesse Livermore, J.P. Morgan, James Keen, and other, big traders at the time were conducting as campaigns. They could, take the stock, buy out the majority of the supply, and mark up the price this way. So this action, we are learning this in the modern world, and sometimes it's really hard to see on highly liquid stocks, but it's extremely easy to see on illiquid stocks. And therefore, illiquid stocks could be manipulated more. Okay, great. Okay, we should probably go from here. Okay, so really quick now, Ash, and let's not have any more questions on this. I really want to jump into the exercise. If we got into the position between February and March of 2003, with that being a phase C assumption, should we book a loss on a spring and then initiate new option after spring is confirmed? So the question is around like here. So let's say that we're thinking that this is phase C, which we might at that point. This could be a point of entry. This could be a point of entry. So 2-1. So I'm kind of gonna do this in the way of, well, actually it doesn't really matter. So let's just quickly answer this question. So what do we do? Well, first of all, where is our stop loss? Our stop loss is going to be somewhere here, right? So we would be hit if we're just using the stop loss. We probably would be thinking more of getting out of this position even earlier before we are being hit. Where? Well, as the price develops some kind of structure and there is an element of a time stop loss. Within a certain period of time, my position is still unprofitable and it doesn't work. So this is 2.5 months. Would you be getting out of this position or not? So you could have the exit just based on the time stop loss and time characteristics. That's number one. Secondly, we could get out and we could just have a loss. And this loss would be only, let's say, half of our position size. Why? Well, because we only have 2 entries. And we usually would scale in 4 segments, right? So even if it's a loss, it's only 1/2 of the position size. Of course, there is a third decision here. If we're recognizing that this day had a very unusual characteristic of increasing downward spread on extreme volume signature. And if we analyze this bar and we're going to say that this is a potential spring, then we might keep this position on, even with the bar that comes next right here, because supply is diminishing, result is diminishing as well, and then we have a high-low test. So that could be a solution number 3, but you have to be an extremely comfortable with your analysis and with the bias that you are giving this stock. So my preference is probably going to be something like this. If I got in, let's say right here and then here, at some point, I'm going to say my stop loss is going to be somewhere here, and partially I'm going to get out of this position. So close, let's say 1/4. And then it still will be exposed, but not as much. And then hopefully I will go through this. And then obviously, even if I take a loss, my points of entry, just based on what we just went through, are going to be here, 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 this bar, and then we go into this bar, this bar, this bar, this bar, and so on and so forth. So again, look at how we are accumulating this position. By the way, we've done so many campaign exercises at the Wyckoff Practicum course, and I'm showing you exactly the reasons of where we would be getting in, why we would be getting in here, and so on and so forth. So this would be the sequence of entries, possible entries. And every time we enter, we want to enter on the point of no return. What does it mean? This is where the price does not come back to this level. Maybe it just come back somewhere here, but everything else is just, the price does not return. And that's just an element of the risk control just based on how the structure develops and where you enter itself. All right, guys, let's go away from this. And let's just see how much we're gonna do. So I'm thinking that maybe we'll stay until 6 today. We'll see. All right, a volunteer, and you have to actually first. Which bar did we stop at? I think that we've revealed this whole chart, right? Is that what we did? So you have to remind me. Have we discussed 52 to 58? Okay, so I don't quite understand, guys. Have we discussed 52 and 58? Yes? Okay, so we've discussed that. Have we really? I think with Adam, we have stopped somewhere here on 52, right? Yeah, I think that we've discussed all of this and then we've stopped. So let me discuss this, but I know that I've revealed this right here. So let me discuss 52 to 58, and then I want to have a volunteer so that we would start the next segment. So let's look at really quickly at 50 and 51. We said that after this secondary test, which was somewhat successful, look at the levels of the supply here and look at where the price is rebounding relative to the height of the range. We're kind of rebounding off the 1/2 of that range, of that height of that range. So that suggested that we're going to have an upthrust. And the upthrust is usually an element in phase B. So there was a built-in trade right here that would get us above 42 And then at the first signs of the deterioration, we're gonna be looking to sell if this is a very short swing trade. And we see those signs of deterioration in the diminishing spread signature of the 46, in the supply tail, in the increased effort that doesn't produce the same result as 45. So therefore, right here somewhere we will be getting out. After that, 47 develops a change of character. This is a small trading range. On the intraday basis, we just don't see it on the daily. But this is the first bar since the low of 44 that suggests that we are done. This is a confirmation. And we go into the reaction and look at the reaction that we have. The supply increases, and we were talking about first emergence of the supply, how change is gradual. And think about this statement, why change is gradual in the markets. Sometimes it's very violent, right? And everything changes very quick. Like the market that we had in December, January. We were in such a bearish sentiment, and then quickly that sentiment changes. But even with that quickness, we still had a week or two where we could have guessed that the change is taking place, and we could have seen the signs of the demand coming in into the market. Well, here this is the opposite. A change comes gradually at point number 45 because we see that the volume signature has increased. So what does it mean? It has some suggestion that supply has come here. Yet the result is still favorable, so that supply is small and does not produce a lot of the result to the downside. Then at 46, that supply has increased. How do we know this? Well, the volume signature has increased by itself. That's number one. So supply has increased. And at the same time, the result to the upside has diminished. So this means that on the more supply, we're producing more of the stopping action and more reaction within the context of this bullish upswing from 44 to 46. So we see how from 45 to 46 supply increases. Then at 48, we're seeing that the volume goes down. And that suggests that demand by itself is deteriorating. And we see how even if supply is going down as well, we see that the close is lower than at 46, that the tail at 48 to the downside, the supply tail, is more than at 46. So that gives us an understanding that on diminishing supply, we're producing a better result to the downside. So there is some kind of ease of movement built into that bar. And obviously, looking at the intentions, intention behind 45 was to overcome the high of 42. We did that. Intention of 46 was to overcome the high of 45. We did that. And we committed at the close above. Intention behind 48 was to overcome the resistance at 46 and commit above it. And yet we don't do that. Instead, we're closing below the close of 46. So that shows us the timing of when the price is ready to go down, because the effort and the result at this point are somewhat synced. And in the practicum, I'm going to show you, and we're going to have a couple of exercises on synchronicity between the effort and the result. And that defines the beginning of the reaction. As the reaction starts, we see that supply is present, and then on the next bar, we see that supply is present, but demand is coming in. Volume increases, and yet the result is better than the previous bar. What does it mean? That means that demand is there. Demand is present. And we see that also from the tail, from close to close. Look at this close relative to 49 close, and look at 49 and 50. They're almost at the same level. So demand is definitely there. And if demand is there, the first thing is just to stop the price from moving further down. And this means that absorption was happening on the way down. And now we're going to go into some kind of testing. In the testing, supply is going to locally increase at the level of the support. And we see those testing attempts. Number 1, number 2, number 3, number 4, number 5, number 6. Quite a lot of tests here. And the last two bars I have in the price characteristic of a feather. And I'm sure that on the intraday you could see this. So we're coming into the short-term resistance right here, and look how the supply and demand signature is diminishing on the reaction. There is some kind of grinding out action into the resistance. So we know that after the feather, what are we going to have? We're going to have some kind of momentum move, and that goes into 52. Now right away, I'm thinking here that 52 is probably going to be analogous to 45 and 46 if I combine these two bars together. So look at that. Does that look the same or almost the same? Doesn't that have the same intention of overcoming the resistance at 46 and moving further up? Yeah, so let's compare those. So we're going to compare 52 and 45 and 46. And here, obviously, right away, a question is going to be, should we compare the volume signature cumulatively? Or should we compare it just, on absolute basis? And we could do both. In this case, I mean, obviously, we know that cumulatively there's going to be more effort right here to push the price up, less effort here. But I would use probably just an absolute value. That just tells me that the increase in the volume signature, which is one of the highest increases since the sell-in climax itself, is most likely carrying a lot of supply. So there is some supply increase. So I know that there's going to be a gradual change that's going to come, that's possibly going to come at some point. Where is the confirmation of this idea? Well, the first confirmation is just in the bar number 52 itself. Even though it looks bullish, and this is where amateurs are going to make a mistake. And this is the whole game for institutions. Amateurs are getting excited. Weak hands are getting excited at 52. It looks bullish. By the conventional technical analysis, look at the volume signature. Does the volume confirms the price action? Yes. The volume goes up, the price goes up. Volume confirms the price. So, but a little bit erroneous statement in this class, because the volume needs to confirm not necessarily just how bullish the bar is. It needs also to confirm a commitment for this bar. What was the commitment? The intention was the commitment above 46, the high of 46. Do we do that? No. So we're seeing an increase in supply that stops the 52 bar from committing above the resistance. Bullish or bearish? Probably bearish. Just because supply emerges and it has the capacity to stop the price from going further up. So that's the first sign of supply emergence in this area. Then the next confirmation is going to be at 53. So 53, look at the level of the supply. The level of the supply is increasing, and then we are producing a relatively big supply bar to the low, and I would be thinking that this acts, if 52 acts as a buying climax, 53 acts as a change of character and automatic reaction. Kind of reminds me of 46 as a buying climax and then 47 as an automatic reaction. So again, we are comparing these bars of these two areas using the analogs. And we're seeing that the 53 change of character, a change of character at 53 is more bearish than the change of character at 47. Multiple conclusions can come up out of this. We have not overcome the resistance at 46, 48. We stopped. Then we tried to overcome, we gapped up on 53 and then instantly went down. And that change of character is so much more than at 47. So what kind of deductions could we have here? Even at that point, we could say that there is more, it's more bearish because there is more supply and there is more result to the downside. So we know that if we had a reaction from 46 to 50, most likely the next reaction that we're going to have is not just going to be to this level. It's probably going to extend. And where would it extend to? Well, what are our targets? So the low of 44, the low of 40 and 41. So this is our target zone. And here with the target zone, we would be thinking that if this is an overbought condition for this target, then this is going to be an oversold condition. And we would be thinking that this is a good trade for us, so we would be looking for an opportunity to open the position here. Now, there is something wrong about bar number 53 if we're thinking establishing the position right away. What is wrong? Well, we see that on a short-term basis, we have a tail that is a demand tail. So this demand tail suggests that short-term, we're going to have some kind of attempt to rally at this point. Plus, think about the momentum on 52. We still have not deteriorated that momentum yet. So that confirms that on a short-term basis, the rally might happen. So we just need to see. And if the rally is going to develop, we're probably looking at the trading range like we had at 46, 48. So next bar, 54, is a very interesting bar because this is an analogous bar to 52. Look at the effort at 54 in comparison to 52. It's the same. Yet, what could we say about the result of 52 relative to the result at, 54 relative to the result at 52? Well, we see that the up spread is definitely diminishing. We see that the close to spread is deteriorating as well. We are seeing a tail here on this bar where we didn't have any tails at the top of the spread at 52. So that suggests some kind of supply or deterioration of the demand, and with the volume signature, most likely increase of the supply. So we're even thinking that there is more supply at 54 than at 52, just because of how result is being shown to us. We also look at the close to close. And we are seeing that definitely in the case of 52, there is more progression from close to close. So again, deterioration. And then the intention was obviously the same as the bar number 46, the same as the bar number 45, the same as the bar number 52, the same as the bar number 53. The intent is to commit above the level of the resistance, and we still cannot do this. And now commitment line is slightly higher even. But even if we use 46 as a commitment line, we're closing below it. So therefore, no, intention was not fulfilled. So all of this is extremely bearish, and the result of bar number 54 is deteriorating off to bar number 52. So now we know that most likely we're going to have some kind of reaction. There is still some momentum on bar number 54. We might assume that, we are in the trading range at this point. We would be looking at the phase analysis and so on and so forth. And then bar 55 comes. So if we said that 54 is more bearish than 52, then 55 is much more bearish than any of these two bars. Why? Well, because the effort is almost the same or just slightly below. Just slightly below or equals the previous efforts here. And yet the result is so much smaller. We don't have the same type of spread. It's very condensed, diminished. We are not closing above the high of the 54 bar. And that suggests that the intention was not fulfilled. And that's bearish by itself. So this 55 is a much more bearish bar than 52 and 53. And therefore, again, change happens gradually. And the reason why it happens gradually is because there is no way that the CO or professionals could unload their positions instantly. If they do, they're going to influence the price in such a way that we're going to see more of this type of movement out of this place. Here at the top, they're trying to sell in such a way that would not move the price significantly down before they get rid of the stock. And then what comes next? 56 has a deteriorating supply signature. And that's again going to be something confusing to a lot of amateur traders. Why? Well, because first of all, they're not going to see supply at 52. They're going to miss increased supply at 54. They're going to miss supply at 55. And then when the down bar happens and they see that, okay, well, maybe there is a deterioration, decrease in supply, and it's still within the context of the uptrend. We're close to this long-term support. So, I should get in here, or I should add. And obviously they will be mistaken, because we know that all of this, up bars contain supply signature in the volume signature. So therefore, what is 56 then? Because now that we're thinking what has happened, we're seeing supply, 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 and then lower supply. And yet what happens? We are actually committing at the close of the 56 below the level of the bar of 55, which was the last attempt to commit to the upside. So we have not experienced this yet, right? Look at this bar right here, 52. Do we have a close below? No. Look at this bar, 53. Do we have a close below? No. 54? No. 55. So I'm only going through the bars that had some supply signature in it. Yes, for the first time we have that. But it happens on the diminishing supply signature. and yet intention has been satisfied and fulfilled, and therefore this looks like a timing tool for us to consider that this is when the move is going to start. And by itself, with this commitment to the downside on diminishing supply signature, this bar is an ease of movement bar. And that's how we would view it. Could we open the position here? Yes, absolutely. We would be thinking about opening the position here. And then we would be thinking we're probably waiting for some kind of LPSY backing up type of action, and also production maybe of a more manageable major sign of weakness, which comes at 57, especially on the intraday level. You will have to look at this as a more as a trading range right here from 52 to 58. So if 57 is a sign of weakness, then 58 is a LPSY, last point of supply. So there are quite a few places here that we would open the position, or we can open the position. First bar at 57, still somewhat vibrant, but still, look at the levels of the supply. It's still there. So all of those bars is just basically selling. And the first bar is active, aggressive to the upside. So we should be expecting some kind of retest. So retest is coming like this. And this would be our last point of supply. So we could open the position there, somewhere here. And then as we break out to the downside, this level is also could be considered for opening the position. So 3 places that we could do this. Obviously, we could also do this on bar number 55. And the reason why we could do this is because within the longer term structure, and some of you who sent me the homeworks, you guys did a really good job because you were thinking that this is our trading range right here. It's just up sloping. And then this is phase A, test and B, C. And therefore, we could have a trade here. Okay, I don't mind that, and I don't mind that trade at all. This is a good trade. I just want us to understand this. How does it happen? How do we compare on the analog basis, what is happening in the second area compared to the first area, on the swing 18 compared to swing 16. All right, so if we're in this position, how would we handle it? How would we manage it? Well, let's assume that we're fully invested already in this position. 58 bar is really good for us because it still shows that supply is increasing on the way down, so we're feeling really well. And there is a suggestion to add right here, which we would. And then look at how the price moves to the downside, the characteristics. Diminishing supply signature, and as we come close to our target zone, we are starting to experience some kind of buying as the oversold zone acts more as a value zone right here. So there is some buying around 59.60, and then the price continues to the downside and comes below into the oversold condition, below 40 and 41 on increased volume signature. So right away here we would be thinking, what are we doing here? Are we experiencing a distribution, a continuation of the distribution that we have had, or could we possibly be thinking about the trading range and maybe more of the accumulation type of action? So with that, guys, I want to see who would like to volunteer to go through the next segment with me. So just say yes, and hopefully somebody who has not done this before. And we'll go for maybe 20-25 minutes after this. I'm waiting, waiting, still waiting, still nobody is saying yes. Now I'm curious about why nobody is saying yes. What are your thoughts inside of your head? Why you're not stepping in? This is an excellent opportunity to advance your knowledge. Yes, it's uncomfortable. I get this. You don't want to do this. I get this. But that's the only way. All right, let's go to Doug. Some motivational speech for you. Hey, Doug.
Hey, how you doing?
Good. I can't hear you really well. Could you be closer to the microphone, please?
Sure. How's that?
Much better. Much better, Doug. All right, so I stopped the analysis at around 61, and I said that there are probably a couple of scenarios where either looking at the distribution, and this is just, a first move or like a second big move to the downside. And the second scenario, maybe we're in the trading range and we need to define the bias of this trading range. Let me ask you a more general question. How would you approach this puzzle? How would you approach this problem? What are the first things answering those questions? And basically the question is, are you bullish or are you bearish at this point? How would you think about it? Like, I want to understand the logic at this spot so that we would either say, yes, this is good, or we would adjust this logic. So what are you thinking?
Well, at point 61, although it is a bullish bar and it's finishing near the top on its close, it's still, in terms of the recent activity, it hasn't really accomplished very much yet. There is some demand. I guess the other factor that I'd look at is there is a fairly big
Doug, I lost you.
Sorry, I hit the button. Yeah, so they're on 61, the extenuating factors, there's a pretty big demand tail coming in on 61. But again, its close is really not really moving too far up, and the two previous, bearish bars, it hasn't really accomplished a whole lot there.
Okay, so therefore the bias
The bias to me is still bearish.
still bearish. Okay, so let me ask you another question. It kind of like a continuation question. For the bearish bias, what do we have to see from the price and the volume signature as well to confirm this assumption? So what would be kind of like the next, how would the price structure unfold next if this is a bearish scenario?
Well, there is, that bar at 61 has one of the highest volume signatures, which indicates there's still a fair amount of supply that is present.
Mhm. Okay, but I'm asking you, if you're thinking about the bearish bias, how would the structure develop after this? Would it go down right away? Would it consolidate? What should happen here and why?
Okay, my just looking at it, although that bar at 61 again has, as I said, some demand tail, it's the level of activity which makes me think as it goes forward, yes, there will be a reaction, but how strong that reaction will be, it doesn't look like it would be very strong. So
You mean after 62?
up to 62, sort of that swing, what is that, swing 20 we're calling it.
Oh, okay. So the reaction to the upside. Okay.
Right.
Okay.
So
So,
there is likely, because there has been some stopping action by bar 61,
mhm.
but it's with the large volume signature, it makes a little bit questionable of how far that any reverse rally is going to rise.
Speculate. I'm trying to extract this information from you. Speculate as to what's going to happen after 62.
I'm speculating that it is going to resume its downward trend.
Okay, great. So, and that's kind of like what I wanted to hear. So therefore, if this is the case, if the price is going to continue to the downside from 62 and just going to go down, then how would we label 61 in the relationship to the 40, 42, 44, 55? Could we label this whole thing?
You could label it, I guess, as a spring.
Hold on a second. Are we talking about the bullish scenario or a bearish scenario? Because you said that you would be looking.
Yeah, I guess, or a sign of weakness, I guess, would be probably more appropriate in a distribution
Okay,
scenario.
let's review really quickly. So if we're talking about a distribution, and in this case, the original distribution is right here at the top,
Right,
then this is going to be considered by us as a redistribution. So redistribution is going to look like this.
right.
Sell-in climax, which is going to be intermediate sell-in climax, not terminal, not final.
Hmm.
Secondary test, phase A, phase B, upthrust into phase C, major sign of weakness, LPSY, and then a continuation to the downside. I want you to label this whole range.
Okay, so the way I was sort of looking at it is 61 is your sign of weakness. Uh, 62 would be the LPSY.
Okay, I want
Uh,
everything.
you and we're going back through there, then up. We're looking at 55. Then would be the upthrust.
Okay,
Um,
phase.
that would be a phase C.
Hmm.
Yeah, and then you have prior to that your secondary tests, which would,
Um,
or,
do phase A first.
oh, okay.
So 40
Um, yeah, so that would be your sales climax
selling
coming up.
climax.
40, 42 would be your automatic reaction.
Hmm.
And yeah, and then I was going to say that you have your secondary test, which would end your phase A,
Okay. So see
and
how
then
simple
the
this is,
rest.
Doug, right? So phase C, define phase C, define phase A. Everything is between is B. You don't have to think about what's in B here unless I'm asking you here, like identify 46, 48. So just a small shortcut for you. Okay,
Hmm.
so yeah, it looks like it, right? So here is a schematic. Here is how it looks. Now, let's talk about characteristics, right? So I want to extract from you the information on the major sign of weakness and LPSY. Okay, so major sign of weakness, obviously in phase D, are going to have what type of the characteristics?
It's going to have broken the support.
Okay, so but in
That
which
was a step.
way? In which way? Because we could break support with the spring as well. And our conversation here is going to be more about this major sign of weakness or as spring, right? So something like this. So what we in both cases we will go below the support level. So I want to establish the level of commitment, price commitment that major sign of weakness will have in comparison to a spring.
Yeah, just looking at this chart, I mean, the one of the characteristics on the spring would be that it does, which is happening here, is it doesn't last very long um, below the support, and there is a change of
Okay,
character
okay. So
into the
you kind of
upwards.
jump in forward. I understand your logic there, but I want us to stay on this thought for now because that might, I see that you understand this, but I want others also to understand as well. So major sign of weakness is going to commit down in which way in comparison to the spring? You said that commitment of the spring is going to be, let's just call it
Oh,
temporary.
yeah, I guess perhaps what. you're saying there is that you have the commitment is to the downside to the close. Would that be
Yes, by the commitment, we are looking at the close.
right?
And we usually would like to see that commitment, right? So let's talk about the commitment. That's okay if we're reviewing this, guys, because we need to. Okay, so commitment. How would we measure the commitment? This is a temporary commitment when the price just commits with one close. This is going to have a progressive commitment to the downside where we have multiple closes that are below the levels of short-term commitment between the bars here. So 3 closes. So this is more of the temporary commitment. And this is, and then another one, a bar like this. So imagine a bar like this. This is more of the attempt to commit. So it tries to commit on the intraday level. We see this from the tail of the bar, but it doesn't close below the support. Next bar, more permanent, more kind of like more significant commitment. At least one close below, but then it goes up. More permanent commitment where we have multiple closes. And not only that, the closes to the downside are showing some progression as they close lower and lower and lower. So this is just on the commitment itself. But let's come back to the major sign of weakness. So you said that with this spring, we are going to have somewhat of a temporary commitment. Maybe one close, maybe this is an attempt to commit to the downside. Now, what kind of commitment to the downside would we have with the major sign of weakness?
Well, it's a longer duration.
Okay, so stays
It stays below the level of support for a
below
longer duration.
support longer. And this usually is going to mean that you might have multiple closes.
Right. Which I guess in this case you have 3 as it looks.
Well,
3,
again,
maybe 4.
we're only talking about the progression of the commitment. If we have any up bars in between these 3 closes here on the commitment, we're still going to count 1, 2, and 3. Why? Because those are the most important bars for us below the support. Are we staying below the support? And are we progressing lower below the support? So let's say multiple closes, but the idea that you said that staying below the support longer is the correct one. Because if we're going to have multiple closes below that would suggest that we're staying below that price, that support level. Okay, so what other characteristics? Don't think about this right now. Don't compare this. Don't think about the spring. Don't think about the major sign of weakness. Let me teach you. What is the next characteristic that we would be looking at on the major sign of weakness that would tell us that, yeah, this is a major sign of weakness and not necessarily a spring? And I'm going to give you a hint here. I want you to look at the characteristics of the move to the downside from 55 to 61. What would be the characteristic of a major sign of weakness as the price moves down?
Would it be accelerating to the downside? But I guess that applies also to a spring. So.
But there might be a slight distinction there. Look at 37 to about 39, right? So this is a sign of weakness. You could use this as an analog here in your comparison. So what does this spread do?
Okay, so the spread is it is increasing.
Yes, increasing relative to what we've seen, let's say 33 to 35.
Right, which is happening in this particular case also.
Okay, where exactly? What are you comparing it to? So let's look first. Hold on. Don't rush. This is very valuable. Uh, what spread are you looking at, downward spread from 55 to 61? If you would average all of the downward spreads in this area, what do you think the size of the downward spread would be?
It would, it looks like it would be around the size of the major sign of weakness bar.
Like this one right here?
Yeah,
Yeah, probably will be something like this, right?
right,
Would you say?
right,
To the
right.
downside. So this would be an average down bar.
Hmm.
Okay, so is that threatening?
Is that threatening? Is that
Yeah.
what you're saying?
Is that as threatening as the downward bars from 37 to 40?
No,
Is it the same size as 43, 49, and 53?
no.
Okay, so then what other characteristics do we need for the major sign of weakness here to show us that indeed this is a major sign of weakness? We said it's in the spread, but also it should be in the volume signature, right? So we see
Right,
how the volume starts to increase here. And this is slightly different. This is more, comes as an ease of movement. And even if we said ease of movement here at 56, look how different this is of movement in the distribution formation here from 33 to 37.
it's definitely a larger, a lot more volatility and a larger spread in those bars
Yeah,
there.
if we would compare two swings, we would compare a swing from 37 to 40 with the swing from 55 to 61. Which one is more bearish and which one is more bullish? Or let me rephrase this.
Well,
Which one is more bearish and which one is less bearish?
well, definitely the 37 to 40. What is that? 41 is more bearish.
Yeah, so we want basically to see the volume increase on the major sign of weakness. Why? Because we want to see selling, increase in
Right.
selling. Do we see a substantial increase in selling in this area? So look at, let's say, 58
Yeah.
as the bar that does have some selling.
Hmm.
Which bar else here do you see a substantial selling? I'm going to be extremely detailed here because I want you guys to get this, and Doc, I want you to see this as well. 56, does it has a lot of selling?
No, it doesn't.
Okay. Uh, First downward bar after 57, this one right here, does it has a lot of selling?
No, it's small again.
Okay, so 58 we discussed. Yes, there is some
Right.
selling.
Mm.
Okay. And then next bar to that.
Yeah. Same thing. It's relatively small,
What's
but
the
it is
intention
increasing.
behind this bar?
Uh, the intention would be to go beyond bar 58, which it did.
Well, here
It's to the downside.
we see that there is an attempt to rally here. So in reality, this volume signature is showing us an increase in the demand. And the demand comes because of this bar right here. This is where they bought in before. So someone's thinking, I'm going to do the same. I'm going to buy at this level because this is an area of the support, and then the price is going to go up. They're lucky for like a moment there that the price goes up, and then it's being sold into them again. So we can't really say that this is, a lot of selling. Some buying is behind that as well. Okay, what about the next three bars or the next four, down bars?
Yeah, the volume is down. I was looking at it from that intermediate bar 2 after 58 as there's an increase in volume happening up to
Okay.
61, but
Don't go away
then,
from me. Don't go away from me. Just
okay,
stay
so,
with me. Stay with me.
yeah,
So, because there are so many details, if we're gonna just side note, we're gonna lose the logic here. So, looking at this volume signature, is there a lot of sell-in on the way down as we go down? Probably not.
not, yeah,
Probably not. Then we go into the 50, 59 to 60 area. There are attempts to rally. So some demand starts to
right,
occur here. So here's a function of the demand. And we're still failing, but are we failing on the increased supply that's coming in?
not at this point.
Demand is increasing and the volume signature locally increased, but it's not as much as what selling we have had before. So selling is going down. So we kind of see through the progression of this reaction that the selling is actually going down. So now let's combine everything. And
So,
again, just kind of stay with me. Uh, we've said that we need to see what's going to happen with the commitment below the support. We see only one close below, and then the price recovers. And recovers relatively quick, right? Then we said that a major sign of weakness is going to have the characteristics where the volume is increasing and therefore supply is increasing on the way down. Plus, um, the down spread is showing some kind of also element of the increase of the result to the downside. Do we
mhm,
have?
yeah, we don't have that.
We don't have that. Okay. So if we don't have that, then it's probably not a sign of weakness, at least for now. At least we need to confirm this. Then probably we're thinking that this could be a potential spring.
Hmm.
Okay, so now again, we're not done. So guys, don't think that we've defined this. Doug, let's talk about this spring. What kind of structure this spring would have around the support? So we are committing to the downside, and then what should happen after the spring?
It should, as the name implies, it should spring. There should be a reverse
Mhm.
to
Okay,
the upside.
okay, so we have that. So that's the first confirmation. The price temporarily commits below the support, has some kind of demand signature on both of the bars,
Right.
and the price comes back into the trading range. So we are confirming a couple of things here. Number one, short commitment, temporary commitment to the downside. Number two, emergence of demand. Number three, coming back into the trading range
Trading
above the
range.
support. Number four, what should happen after that comeback?
It should test.
Test. So we are waiting for a test to
For,
happen. If test happens, this is going to be another confirmation that this was a spring. What is the next one?
after that,
Yes.
then it should rise through the trading range
Yes. So
to some
this
sort of sign of
this
strength.
commitment below this local resistance that is being created between the low of the spring and below of the test, this high right here, I'm going to give a name to that. Because this is such an important localized high right here. If we have a local breakout of that, it's going to act as a confirmation, final confirmation that this was a spring.
Hmm.
Let's kind of like stay in this space a little bit. Let's observe all of this. Okay. So
Hmm.
we're thinking that does not look like a major sign of weakness. We might still be mistaken. If this is a spring, give us the test. Test number one is there, temporary commitment. Test number two is there, demand is present, and there is absorption on the way down there. The test number three, the price comes back above the support level and comes back into the trading range. We still don't have test number 4, which is the test itself, and we don't have the test number 5, which is the local breakout above the resistance level, which probably will be somewhere here.
Mm-hmm.
So this is what we're looking at. If we have this, the breakout, this is going to confirm the bias to the upside, at least, a short-term bias. By the way, really quick question, Doug. If this confirms, actually 2 questions. If the breakout confirms that this was a spring, where is the target for that trade? That's number 1.
The target for the trade would be up at 50, well, in the area 46, 48, 53. Yeah.
Okay, great. So this is our target number 1. If this is a spring, then what is the rally? How would we label the rally?
How would you label the rally?
Think about spring, phase C,
Oh, you'd be phase D, yes.
phase D,
Yeah.
and this rally would be labeled as
Major sign of strength or possible major sign of strength.
major sign of strength. Because if
Right.
we're in phase C on a spring, then the next thing what's going to happen is phase D and a major sign of strength. So our target is not necessarily just on the boundaries of the resistance here of 46, 48, 53, 55. Because what is the definition of the major sign of strength?
That it goes above the trading range, closes above the trading range.
Closes above the trading range boundaries.
It didn't make a commitment above resistance. It makes a commitment above resistance.
Exactly.
Excuse me.
Right. Exactly. So the major sign of strength, in comparison to all of the upthrust that we had before, would travel through the trading range, starting with, at the lows of phase C, would commit above the area of above the resistance cluster that was created in phases A and B, and then would come back into the area of that resistance. Now that is going to act as a support. So we have a target number 2 as well, somewhere here. So 2 targets. So that was the question number 1. Secondly, if that were to unfold, where would we open a position?
You'd be opening a position after 60. Oh, after that test.
After the test.
The first test.
Where
right.
else? Okay, so number 1.
Right. Well, up at the backing up action that will hopefully occur.
You mean right here?
Yes.
Okay, but before that, are there any other places?
I guess perhaps after it passes the level of 62, you might enter.
Absolutely. This breakout acts as a confirmation, as we said, right?
Right.
And this confirmation equals just a point of entry for us. Why wouldn't we get busy here with this trade at this point? Because if we're thinking that target 1 and target 2 are so far away, it's a really good swing trade. Even if we are wrong and this is not the major sign of strength, and it's going to become an upthrust like we've experienced before, it's still a really good trade because we have a lot of distance here. This was a very quick trade. We probably might not even consider this. This trade was not was quick, and also we might not consider it because within the contextual structure of where we are, phase B, we're not necessarily that happy about this. But this was a good trade, and then this could be a good trade. So these are the 2 swing trades within the context of the structure. And then when we are in this position, and if the major sign of strength characteristics are going to unfold, like what we've done with the major sign of weakness comparison to the spring with dog, we're going to do the same process when we're going to look at that rally, and we're going to say, are there characteristics of a major sign of strength as the price moves up? are there definitional characteristics of the major sign of strength as the price approaches the resistance? Is there any supply that is starting to emerge in this place? And if it does, what's the rate of absorption for that supply in this higher level? And then we'll go through the same process that we've done at 61 with the major sign of weakness in the spring. So therefore, on the way up, we do have quite a few opportunities to establish this position. The test itself could be our first point of entry. The breakout above 62 could be a second point of entry. Any type of significant bars to the upside as a sign of strength bar could be also another point of entry. So we could potentially have maybe like 2-3 points of entry here. That's number one. We definitely want to slow down as we're approaching the resistance because we don't know if supply is going to come or not. We'd rather wait, as Doug has said, for the backing up action or a confirmation of that. So that's going to be kind of like our strategy. Okay. Well,
Is there, between 61 and 62, what sort of threw me off is the declining volume signature. And that's what made me think that it was not a spring.
Yeah. Okay, well, let's definitely address this, and then we have one more point I want to show you guys, where we are with that, and that's going to be your homework. We definitely going to go much faster next time, Doug. Don't think that this is you. Everything that you and I have done is fantastic.
That's great. Thank you very much.
Yeah, because you brought up correct thoughts, and we adjust, correct in a way of your thoughts produced correct questions. And it was great how we went through all of this because the logic was presented, so we could be mistaken, guys, and it's not a huge mistake to be mistaken in our analysis. It's a huge mistake not to analyze it and then not to adjust ourselves in the logic. So, and that's exactly what we've done here. But let's come back to the question that Doug is asking. The volume signature is diminishing. So therefore, what is happening with the supply, Doug?
The supply is diminishing.
What is happening with the demand?
The demand would either be the same or is diminishing somewhat. Actually, it'd have to be increasing a little bit, otherwise it wouldn't go up.
Okay, so and this is where our analytical issue is lying, right? So, could we have this situation? Could price go up on diminishing demand?
Yes, if supply is exhausted.
Yeah, if supply is poor or exhausted. Is supply poor or exhausted or diminishing here?
Yeah, it's diminishing,
It's
right? It's
diminishing.
poor.
Demand
Right.
is diminishing too. But yet, what is the price doing?
Price is going up. This is what we discussed last week, I guess.
Yes. Remember that chart with Home Depot? Remember the
Right.
ice cream story?
Yes. Great
Yeah.
story.
So ice cream story is all about diminishing supply, diminishing demand, and yet the
Mm-hmm.
price is going up. So
Right.
kind of the same here, but there are two concepts here. So the ice cream concept is all in how the price goes up and how the volume with the supply and the demand are going down. But the one that precedes it, and we didn't go through this a lot, was bar number 61 and bar before that. On these two bars, we see that the volume has emerged, and it's only temporarily that the price went down. So the question here is, how could the volume signature increase so much? How could supply increase so much, and yet only one temporary commitment to the downside, and then the next bar, it tries to come back? So we know that with this increased volume signature, we're probably thinking about the increase of the demand. So therefore, we're thinking about absorption on the way down that is
Mm-hmm.
happening.
Mm.
So,
Great example.
so then we are observing the supply on the way down, and then supply is exhausted, it's diminishing, and demand is diminishing only because it has come here. It's enough,
Right.
it's sufficient. There is no more need for additional demand, at least at this point. Unless supply emerges, and then demand might come back and emerge again. If the CEO is thinking that this is a good value for me here and this is a good selection.
And at 62, that doesn't happen, does it? The supply doesn't increase uh, tremendously. So.
No, there is nothing. So if we would be considering this as a test, we probably would say it's a successful test. The test
Mm-hmm.
is happening above the support. The test is happening as a high, low. We obviously need to reverse that. We had, a short-term high right here, and supply is one of the lowest supply signatures on this chart, and one of the lowest signatures since the selling climax. So it looks like a good test at this point, at least for now. So, Doug, that's the main point for you, just on a kind of like personal level, right? And personal, I mean like for you on an individual level. The price might advance when demand is diminishing, and that would be the function of exhausted supply.
Mm-hmm.
And we definitely want to combine that concept with the absorption on the way down that we see from this volume signature right here. Then also add the layer of the structural analysis, characteristics of the major sign of weakness in comparison to a spring. And that kind of brings me, I'm going to make a note. I'm going to make a slide for maybe next cycle where major sign of weakness is compared to a spring, and then upthrust is compared to a sign of strength. And I think that could be, a better explanation. What else, Doug?
So it's all contextual, isn't it?
It is. Yeah, of
Yeah.
course. Yeah, that the context is always going to be a layer for us. So we're going to
Right.
have the layer of interpretation of the bars, volume bars, and price bars. We're going to have the layer of the context in terms of labeling. We're going to also have the context of swing analysis, like we did from 55 to 61 compared to 37 to 41. There's going to be also the layer of uh, characteristics of the specific Wyckoff events. So the comparison, right? So how it should look like. And that's why I'm saying to you guys that all of the material that we've learned, from the first months, you gotta review, you gotta go back there, you gotta pull out from your library of slides, that slide on major sign of weakness and a spring. What are the differences? How do I actually, interpret it here, and so on and so forth. Okay, great. Um, Doug, one more thing here. Let's see what happens next. Okay, so here we're gonna start next time with this slide, but what I want to talk to you quickly here is actually let me just pose this as a question for the homework. And obviously the homework, guys, is just to watch this segment again of the exercise segment, rewatch it and make notes, send those to me. But the homework question is gonna be this. Bar number, I'm extremely interested in bar number 64 and 65. Those are the breakout bars. Are we entering the position on these bars or not? So let's make this a homework. And this is where we're gonna stop today. Would you be entering this on these two bars, on the breakout bars? Because our strategy was a sprint, a test, and we are buying here on the breakout. So the question is, would we be buyers on bar number 64 and bar number 65? Doug, again, that was a really good job. And I commend you for stepping in and being in that maybe uncomfortable zone, but going through this and learning and staying with the logic of it and kind of like finishing this. So really good job.
Thanks a lot. That was great.
Okay. All right, guys, this is it for today. Don't forget the homework. And definitely we're gonna continue next in the next class. I think we're gonna have less of the theoretical material in the next class. I want to finish this exercise. If you can believe I have 30 more slides on this, 30 plus slides on this. So at some point we're gonna go really fast. A question here from Nilesh. Could you please upload power slides for this exercise? So usually we provide you guys with what? With the PDF? Is there a difference for you, Nilesh, between PDF and the power slide? I could definitely do that. You mean the homework power slides? Okay, yeah, I could do that. I could do that. I probably should do this in a slightly different way, but yeah, I could definitely see how it's easier than the PDF. I'm just thinking about all of these numbers because in the PDF it's different, but I'll probably just copy paste it and still paste it into the PowerPoint. So yeah, thank you. All right, guys, I'll see you next week. Good class, good job. We're moving along, so let's just finish it next week. Thank you, guys, and bye-bye.